As of the close of the last regular trading session on June 29, 2026, the market is closed, and Ondas Inc., trading under the ticker symbol ONDS on the Nasdaq, finished the session at a price of $8.02 per share, registering an intraday gain of 1.92% on a trading volume of 40.86 million shares. This minor rebound comes on the heels of a highly volatile stretch that saw the stock plummet from its early June peak of nearly $14 down to a low near $7.31. When you first glance at this sharp correction, the immediate reaction might be to assume that the underlying business is deteriorating or that a sudden crisis has derailed operations. However, the reality hidden beneath this dramatic slide reveals a fascinating divergence between market expectations and execution mechanics. While retail traders on platforms like the Robinhood app or those pursuing online investing through their individual brokerage accounts have been panicking over the sudden drop, the company actually wrapped up the second quarter securing over $40 million in new autonomous defense orders, pushing its total second quarter order activity above $150 million. This creates a compelling curiosity loop for anyone tracking small-cap growth assets. Why would a business showing an order book expansion of this scale see its share price sliced by nearly 40% in less than 30 days? To understand this tension between expectation and reality, we have to look at what the broader investing public believes about this asset versus what is actually taking place on the corporate balance sheet. The common ground among growth stock investors is that massive top-line growth and major government partnerships should naturally drive a stock higher. When news hit that the company's Centrix subsidiary was partnering with Lockheed Martin to integrate its cyber-over-radio frequency counter-drone technology into the Sanctum counter-unmanned aerial system platform, the expectation was a massive breakout. Instead, the market met this announcement with intense selling pressure. The deeper reality that caught retail investors off guard was a major secondary share offering of roughly 3.4 million shares tied to its recent OmniSys acquisition, which created a near-term supply overhang. Active traders using the Interactive Brokers platform saw this dilution coming, but everyday investors executing trades through standard investing sites were left wondering why stellar defense news was met with a falling share price. This is exactly where the disconnect lies, as the market is currently forcing a brutal tug-of-war between aggressive equity dilution and explosive operational scaling. The recent stock movement throughout June highlights just how extreme these daily swings have become. On June 26th, the stock experienced a massive volume surge of 123.72 million shares, closing at $7.83 as the market attempted to digest both the company's expansion moves and the annual Russell Index reconstitution. Getting added to the Russell 2000 and Russell 3000 indexes drew substantial passive buying from exchange-traded funds and institutional managers who utilize sophisticated platforms like Fidelity Wealth Management to balance their portfolios. This institutional accumulation helped absorb some of the selling pressure, but it was not enough to completely offset a coordinated short seller assault. Short interest on the stock has climbed to an elevated level near 34%, indicating that a significant portion of the market is actively betting on a prolonged retreat. For individuals managing their own self-investing portfolios or using digital tools like SoFi Active Investing, this short concentration introduces an immense amount of tail risk, transforming a standard technology investment into a high-stakes battlefield driven by technical liquidity flows rather than pure fundamentals. When you analyze the trading volumes across major online investment channels, it becomes clear that macroeconomic pressures are also playing a major role in how this asset is treated. Speculative small-cap growth names have faced a severe sector-wide sell-off as sticky inflation data and shifting Federal Reserve interest rate expectations have driven capital out of long-duration tech assets and back into safer large-cap options like Apple stock or Nvidia stock. Investors who typically park their funds in a robo-advisor system like Schwab Intelligent Portfolios or look for stable long-term returns through standard Fidelity mutual funds or steering clear of these highly shorted, high-growth microcaps. This leaves the daily price action at the mercy of day traders and algorithms. On June 24th, for instance, the stock dropped nearly 10% in a single day, collapsing to $7.68 on 74 million shares traded. The technical breakdown below the 50-day moving average triggered automated stop losses across major platforms, amplifying the downside momentum despite the absence of any negative corporate news. Please take a moment right now to participate in our channel discussion by providing your feedback in the comment section below. Comment below how many shares of Ondas you currently hold in your individual brokerage account, and let us know if you think the current price drop represents a compelling buying opportunity or a dangerous value trap given the high short interest. To properly evaluate if this pullback is justified, we need to strip away the technical noise and evaluate what the company actually does and how its business model functions. Ondas operates a dual-pronged business focused on proprietary wireless data networks and autonomous drone systems. Their technology addresses critical infrastructure markets, including railroads, industrial facilities, and defense operations that require secure, wide-area automated operations. Their recent strategic moves show an aggressive drive to dominate the autonomous aerial inspection and defense markets, highlighted by their recent $125 million acquisition of Cyberhawk. This single deal expanded their operational footprint into 40 countries, providing them with established revenue streams in the energy and oil and gas sectors. When you look at their older financial reports, the historical performance was often characterized by minimal revenues and heavy research expenditures, which is why older stock market models valued them as a highly speculative venture. However, the reality of their current financial trajectory completely shatters those past assumptions. In their first quarter earnings report for the early months of this year, the company posted revenue of $50.1 million, which represented an astounding surge of over 1,000% year over year. Their earnings per share came in at 81 cents, crushing Wall Street forecasts that had anticipated a net loss per share. This explosive fundamental turn is what initially sent the stock soaring towards the mid-teens earlier in the spring. The company is no longer just a pre-revenue concept. It is actively converting its technology into massive commercial contracts. For retail accounts trading on the Interactive Brokers trading platform or setting up recurring positions through the Robinhood stock trading application, the challenge is separating this remarkable operational turnaround from the technical pressure of short sellers and near-term share issuance. Looking at the financial strength metrics, the corporate balance sheet shows surprisingly robust liquidity reserves for a company undergoing such rapid expansion. The current ratio stands at an exceptionally strong 10.91, while the quick ratio is maintained at 10.28. This indicates that the business has more than enough short-term liquid assets to cover its current liabilities, mitigating the immediate risk of a cash crunch that plagues so many small-cap engineering firms. Furthermore, their interest coverage ratio is sitting at an impressive 73.80, showing that their interest service obligations are within manageable limits. This high level of financial health explains why major research firms like Needham and H.C. Wainwright have maintained strong buy ratings on the stock, with 12-month price targets stretching as high as $23 per share, implying a massive upside from the current $8 trading level. Looking ahead towards the final half of the year, the future outlook for the business hinges entirely on a few key catalysts and potential structural risks. The primary catalyst to watch is the integration efficiency of their 6 recent acquisitions, particularly the Cyberhawk and Omnisys business units. If the management team can successfully cross-sell their autonomous drone platforms to Cyberhawk's existing industrial client base, top-line revenue could continue its exponential trajectory. Additionally, the growing global focus on counter-drone systems provides an ideal environment for their Centrix subsidiary. As geopolitical tensions remain elevated, defense departments worldwide are seeking immediate protection against unmanned threats, making their new integration with Lockheed Martin Martin a massive validator that could open doors to much larger municipal and military procurement programs. Conversely, the risks are equally pronounced and cannot be ignored by anyone engaged in online investing. The most immediate threat is the potential for further equity dilution if the company continues to utilize share issuances to fund its aggressive acquisition strategy. If the market perceives that management is prioritizing top-line expansion at the expense of current shareholder value, institutional support could erode, forcing active managers to liquidate their holdings through their Fidelity IRAs or Interactive Brokers account. Furthermore, if a broader market correction hits the technology sector, speculative names with elevated short interest are often the hardest hit, as liquidations occur across retail applications like SoFi Investing and Robinhood Investments to cover margins elsewhere. In summary, the story of this asset is a classic study in the tension between near-term technical reality and long-term fundamental expectation. The market narrative and general investor belief focus heavily on the steep price drop from $14 down to $8